Hey everyone, Logan Hertz here with Hazeltine LLC. We are continuing our series on healthcare with our partner Brad Owens of Healthcare Unlocked. Brad, how you doing?
Doing great. Doing great, Logan.
Brad brought his smart face today, right, Brad?
Yeah, it used to be four eyes. Now
Now it's an advantage. Now it's
it's
an
an
asset.
advantage, right?
Now it's an asset, not a liability.
Didn't get picked for the kickball team, but here to talk with you today.
Yeah, we want to talk in particular. So we've talked about all sorts of different topics related to healthcare. How do we pay for healthcare? How do we find quality healthcare? Do we do health insurance? Do we do pay cash? Do we do health sharing, direct primary care, all the other options? Today we're going to talk a little bit more about group health insurance. And we're going to talk with maybe business owners or directors of HR, people who are decision makers about group benefits for your company and how do you best give your employees, pay for your employees' healthcare so you can attract and retain quality people? Because obviously, this is something that employees want is group benefits. So, with that said, Brad, you want to give us a little introduction to the topic for today?
Yeah, the decision's been made, the money's there. You're going to roll out a benefits platform. You feel great about the impact you're going to have for your employees as a employer that really cares and just trying to grow and keep attract and retain top talent. You're willing to spend the money. And it is, as we've discussed in previously, the financial commitment it takes to compete in the benefit sphere for a group is pretty extreme and it's a big investment. And so the bad news is, I don't want to be the bearer of bad news, is it just doesn't stop there. So we're going to talk about compliance because once you've decided to offer and have the funds to begin a plan and make that investment ongoing, there are needs and requirements by law and that of how you must message certain things and comply with the law. And for brand new companies that are offering a new selection of benefits, I think there's an assumption out there that, hey, the insurance carrier is going to keep us straight, that they're going to keep us out of hot water. Unfortunately, that's the furthest thing from the truth. Insurance carriers are, whether it's MedShare or anyone else, they benefits carriers are going to shift all that responsibility to you for being compliant. So there are some things to learn, some targets that do move because laws are updated periodically. So you just want to make sure you have a clear strategy of who's going to be responsible within your organization for maintaining compliance, and if necessary, what outside partners are you going to rely on to make sure you're as close to perfection on that as possible? Most people in my spot talking about this, they'll start with the fines. And if you don't do this, there's these daily fines that can build up and it can be a huge headwind and a liability for the company. I don't like to scare people in that regard. I'm here to give you a real world what to expect. And we'll talk about this in a second. I don't think that the fines for noncompliance are the biggest reason why you should be compliant. I think there's another more critical reason for your business.
So, we're talking about a super exciting subject, namely compliance. Why are we wasting our time talking about compliance? The reason is because I think it's one of the values that Brad and I can provide that people don't necessarily think about because a lot of people are probably not in compliance without realizing it. And that's a risk to the business that we can help with. Brad, in your experience, how many of these companies that you are introduced to that you're working with, how many of them are actually in compliance before you talk to them?
Yes, so sadly to say, almost none. And I think many of them have pieces that they've developed that are workable, but almost none have it perfect. And I think there's a lot of reasons for this. I'll spit off a few that come top of mind. I think one of the reasons is that companies typically, when they offer benefit plans, they start offering them when they have a very small number of employees early on. And as they grow, they don't update for that growth. A good case in point is when you hit 20 employees, you are then subject to Cobra. Each state has its mini Cobra, but Cobra is a federal, through the Department of Labor, federal requirement for those that have 20 enrolled employees on a plan. And so a lot of people do Cobra right because it is the most scary of them. The penalties for Cobra are $110 a day for any non-compliance in that regard. Cobra is one of them. You have the EEOC that comes once you hit 100, and then some greater. You have the ACA, the applicable large employer requirements for reporting, and then also the affordability testing, some of that stuff. And I don't want to say all this to confuse or scare anyone. That sort of approach doesn't really work in my experience. But the idea is to do a self review, and we will put links, documents for you to have a checklist to do a self review. And then when you look at it, if there are questions that come up, we are available to answer those questions and give you a little bit of direction there. But the second reason why sort of compliance is not in a state of perfection for most businesses and for most HR departments is the people that they're depending on, their agent broker, frankly, are not experts in it. In some cases, maybe you have a little small regional person that was very helpful when you were getting started and very hands on. And as you've grown, they don't have the ability to grow with you, so you've outgrown your current relationship. That is probably the most common is, hey, we've just been doing it this way for 20 years and never taken a hard look at it. And so getting it on track is really fairly easy. But the key takeaway is as a company grows, they are then subject to ever more compliance statutes. Well, the way I like to describe it is at 50 employees, it's you're a real company now, and I'm not saying that to disparage any company smaller, but I'm saying in the eyes of the government, there's not going to be any get out of jail free cards there. Okay. If you don't submit like for instance, the 1095 reporting, they will hit you with a penalty there. The IRS is in charge of that field, and that's for the ACA reporting. That's a necessity for those over 50 employees, the applicable large employers. And then once you get to 250, the get a bigger company, and it may not feel like a huge company, but the differential, how they treat you is exactly how they would treat a Walmart, an Amazon, a Microsoft. In the eyes of the Department of Labor and the eyes of the IRS, once you hit 250 employees, you are a large employer, and there is no ignorance of the law defense at that point. There really isn't much once you hit 50, but once you hit 250, you're on the same footing territory as Walmart.
Okay, so why is it that so many of these small businesses are not in compliance? And maybe give a couple of examples that you've actually seen. Well, let me back up a step. I want them to understand the value proposition from your end, right? So, because again, I think when you go and talk to an employer, when you go and talk to a small business owner, right? Maybe they view health insurance as just a commodity, group benefits is something where you put a check in the box, and they're not thinking about these other things that aren't going to show up on the balance sheet, but are actual value adds. So can you explain a little bit of that? Because again, compliance to them, that's just putting a check in the box. What are you talking about, Brad?
Yeah. And so this is what I teased a little bit earlier. When I first speak with a prospect or a company, typically where it gets fleshed out is not the Department of Labor or IRS knocking on your door. While the the potential penalties are extreme, and they are extreme. And I've seen in my career seven-figure penalties dished out by the IRS for non-compliance. They're certainly out there. But where you're most likely to run into a consequence of non-compliance is during a diligence period for a transaction. So if you're a business owner, you've grown your business and you're considering selling, I really advise everyone to be ready to sell, be in the shape where they could, because you never know when the opportunity, a lifetime sort of generational opportunity for that type of transaction may come knocking on your door. The private equity world over the last 10 years has exploded. I mean, there was a time when it was just big companies buying big companies. And now even smaller, like service-based companies are getting knocks on their door by private equity platforms. I'm talking about HVAC companies. I'm talking about like electrician sort of companies, and doctor's office, dental practices. They are constantly being offered transaction opportunities to sell their company, participate in a roll up, get on a private equity platform and cash out to some degree. And even if your desire is to have a generational company that you hand off to your kids and hopefully your grandkids, and selling is not on the table, as we have seen, and many times the economics of our given time can change. And it's always good to be prepared just in case. That is when most of these deficiencies get flushed out, is during a diligence period. The first thing they're going to ask you, they're going to give you a list of things they need, but the first thing they're going to ask you is for a Section 125 document. And if you have a health plan, a group health plan currently, and you don't never heard the term Section 125, that should alarm bells should go off. That is the basic document you're required to make any benefit pre-tax. If you don't have that document in place and you're giving benefits to your people on a pre-tax basis, so their contribution, their payroll deductions are not being taxed, that's a problem. And the list goes on. I spoke a little bit about Cobra compliance, but each one of these buckets, if you're offered to go into a transaction and it's an offer you can't refuse, they're going the attorneys for the buying party will diligence that transaction, and they will send you a checklist of documents that they expect you to have. The summary plan description's another one. Depending on your size, maybe 5,500 reports, wrap documents. And I'm not rattling these off to sound smarter to scare you. I'm just telling you the reality. That's what they're going to ask for. And I can't tell you how many deals I've seen explode and not go through because, for instance, they haven't filed ACA reporting. Company hasn't filed ACA reporting ever, and there's no term limit for the IRS on ACA reporting. There is no statute of limitations. So when you buy that company, you're also buying the liabilities that exist for that company at that time. It doesn't shed those liabilities don't go anywhere just because you were purchased and the purchasing entity is doing everything they need to do right. They are then responsible for any sort of compliance issues that existed when at the time that you were purchased. So for sure that can blow up a deal. And for all you've built a great business and you have everything in line and you've got a great price and transformational for your family type of resources coming in, and it all gets scuttled or delayed at a minimum through this diligence process. And so it's not the government, it's the actual private market that's most concerned about this because as any attorney will tell you, there are risks that they will not advise their clients to take on. And so whoever's doing the diligence in this process, they're going to have a diligence memo and they're going to point out all the deficiencies. Some of those are material and are going to stop everything in its tracks. And then some of them can be with representations and warranties overcome. And by the way, I'm in no way an attorney. I'm not giving any legal advice, financial or accounting advice here. I'm just giving you the sense of what happens in the business world when one of these transactions starts, and having everything together and compliant will at least make that part of it. There's several layers to the diligent side for when a transaction happens, but that key layer, which I would argue that and environmental has the biggest ability to kill a deal. If you're trying to buy a series of manufacturing plants and you discover that they went out back and buried benzene, you're not buying that place because you could have enormous liabilities. And much the same with non-compliance on benefits. It can, the liability factor of it can be huge.
So, how do you help your clients with compliance? How do you solve these problems?
Yeah, so we do every client when we first start with them, we'll do a compliance review and a checklist, and it's tailored to look, Logan, almost exactly like what they would experience if they were in a transaction. So we don't do it like you would receive a Department of Labor audit. Okay. That is just overkill. So we're not going to that lengths. There's plenty of HR consultants out there and law firms that will do it at that level. Our structure is to get you compliant enough that if you were to be offered $1 billion or whatever the case is, a super high value for your company, you would be in position, at least from the benefits perspective, that would not derail the deal.
And what are some of the typical things that you see that are missed in compliance with some of your clients?
Yeah, the biggest one I would say is Cobra being done poorly. Most of the times when companies grow to the point of needing Cobra, they will tap and use a third party administrator to administer the Cobra. So these,
Now, let me stop you right there because I know that's always the answer. Yeah, I have someone who handles that. That's always the answer. Yeah, it's taken care of, checking the box. Okay, well, what is that person doing? You don't even have a clue, do you? You never asked. You just want to be told it's taken care of, right? You never actually dug under a bit to figure out what they're actually doing other than charging you money.
and that you could be more right on that. And if you go and search for Cobra third party administrators, you will literally find hundreds of them. And if you have a TPA, congratulations, you're a step ahead of the game. But not all of them are going to be reliable and will vet and make sure that they are complying, they are satisfying that compliance because the Cobra liabilities can be extreme. And also, too, it's one of those places where if you impair the Cobra rights of an individual, you can get on the Department of Labor's list, bad list, naughty list, since we're fairly close to the holidays here. You can get on it pretty quick and get an entire Department of Labor audit, which is not something anybody wants to go through. Looking at your partners, any TPAs resources you have there, and then if you are an applicable large employer, making sure that the compliance documents and the reporting is being done as mandated. That's another big one where if maybe you pay for everybody's benefits, you're the most generous, paternalistic employer of all time. You really truly care and have deep interest for your team members. If you don't file the reporting, the 1094, 1095 reporting, it can get you in a lot of hot water. The fines on that can be extreme. If there's willful neglect, which is a term basically applied to, hey, we just didn't do it. We don't know why we didn't do it. We don't have a reason. We just, the old term in Latin, and Logan, I'm sure you could probably actually say this, but ignorance of the law excuses no one very much applies here. And there's not any get out of jail free cards with that. So we want to make sure the TPAs, and that's typically a space where you're going to rely on a TPA. Most Commonly, people will use a payroll vendor for that, but the payroll vendors themselves are very explicit in saying, we're not going to take liability for any of these fines that may come as a result, even of our errors. And we have to do a double check that those are reliable TPAs, reliable vendors, and then look at kind of the basic things. Do you have a Section 125 plan? That's the easiest start. Do you have a summary plan description? And those are all things we help our clients with. We will use a TPA to get them done. The cost to get them done is very reasonable and inexpensive, much less so than if you went to an attorney to have this done. And they're very reliable. So I think the route you can go is you can rely on a benefits broker, and one that sort of is compliant minded, that sees that as a function and as important a function of their job as getting you the best rates on insurance coverage. You can go with an HR consultant, and there's a lot of different flavors to that. The HR consultant can be a standalone. That's what we have an agreement with you. We operate, you pay us either per hour or annual fee, and we take charge of those aspects of your business. Some people will use a PEO to do this, and that's a very expensive way to do it. And then finally, you can, have a law firm that reviews this for you. I will say that using a law firm will be the most expensive route. The typical ERISA attorneys rates are somewhere, $500 and up per hour. And that will get to be a very expensive endeavor very quickly. But when we engage, we do a basic checklist, the same checklist that you would get if you were considering a transaction, considering selling your company.
So how do you remedy some of these, identify and remedy some of these compliance issues, and how can you be so much more cost effective than say a PEO?
Yeah, so great question. As far as remedying, there are, certain documents that you can just create and go forth and sin no more, and then that's a sort of a remedy in of itself. There's certain places where you really can't do that. If you have failed to file the ACA reporting, those 1094 and 1095s, that would be a sort of a special circumstance that would be dependent what we direction we try to go. There, if you once you pass 100 employees, you're subject to 5,500 filing. And if you have not filed 5,500s, there are remedies for that through the Department of Labor. And then COBRA, generally speaking, it's hard to go back and retroactively fix. You just, if you haven't been doing it correctly, it's something you want to fix pretty much immediately and then move from there.
So how are you so much more cost effective than a PEO? And what is a PEO? Why do some people use them?
Yeah, it's a great question. And I guess I originally didn't answer it fully. So a PEO is the term is really descriptive of a co-employment arrangement, and where your employees, they technically are still your employees, and the Department of Labor and IRS does not recognize officially a co-employment relationship. Ultimately, you still, even if you use a PEO, where essentially you're paying your employees through another organization, they are employees of another organization. You are still the employer of record and still where the liability sits for anything that's not done correctly. Now, PEOs are very structured. They provide some additional benefits, such as if you're having trouble finding affordable health insurance, they have health plans. Typically, where I see PEOs employed are in firms for companies that are big enough to get in trouble, but not big enough to afford a full-time HR director, full-time, very competent HR person. And so the typical size of a PEO client's about 30 employees. That's really the place where you are subject to COBRA at that point. If you have people spread out into I would call them hostile states. California, everybody knows California's got its own set of rules and fairly difficult to deal with from a regulatory perspective. They will take all that burden or the majority of that burden anyway off of your organization. So instead of paying an HR director, whatever the prevailing rate is for that position, you then pay a PEO that's got a staff of people to handle different facets of HR for you, building a handbook, all those things. The other reason why people would choose them is if they've got a work comp issue that they are having trouble, their experience rating on the working workers' compensation insurance is such that they're going to have to buy it in a group setting. It's becoming unaffordable. So PEOs can be a good fit. I will tell you the cost of a PEO can be fairly extreme. It's done as a percentage of payroll. So the typical cost per employee across the industry is somewhere $1,000 to $1,500 per employee per year. So if you've got 30 employees, you're going to be paying roughly 30 to $45,000, which is not a bad deal if the choice is between that or hiring a $80,000 HR director. So it can be a good fit for that. The problem with PEOs for growing companies is that there becomes a scale issue once you hit 70, 80 to 100 employees, then the scale, the math just ceases to work because you're then paying way more than you would even if you had a very high octane, great HR director that you could hire to oversee all that. The PEO is right in some situations. I don't think it's the best fit in others, but that is an opportunity. And in my career, I think I've done a little bit more of exiting people from PEOs once it didn't scale and it didn't work as well. But I certainly have advised and assisted companies with entering PEOs when it made sense.
Give us maybe some real world stories, one of maybe like failure, so to speak, where a compliance issue really hurt them, and then successes where you came in and fixed a compliance issue. What were the benefits of that?
Yeah, I'll tell you the saddest one is just really it's top of mind here, and I don't like to lead with this, but there was this was during COVID. There was a company that I'd worked with for several years. They had about 100 employees, and they were facing financial headwinds, and they were looking for a lifeline. They had several sort of interested private equity firms that were looking to take them over. I think their main issue was debt load and cost of capital and some of those things that really, if you're doing a transaction with the bigger company, they have greater and easier access to low cost funding. So that would have, been something that all parties could have benefited from. And unfortunately, when they finally got to the table, the benefits piece of it was the compliance there was fine. There was no issue there, but the 5500s and there was some speculation about when I started working with them, they definitely were Cobra compliant, but I had not worked with them for the entire time. And there were some liabilities out there. And this was not in a vacuum the only thing, but the deal fell apart and that company ended up going bankrupt. And so the deal that they had fell apart wasn't only due to the non-filing of the 5500. At the end of the day, whoever your advisor is, whoever you're depending on to tell you the right things to do, you got to execute on that advice because it can still come back and get you. Now I make sure it's a habit that any new sort of TPA, once I review the relationships there for the filings, that basically they're sending me a copy that of all the filings as well. I asked to be put on the distribution for that. And where it's gone well, shortly after the Affordable Care Act was released, part of it was confirmed. Part of it was that in 2015, that for applicable large employers, so people with over 50 employees, that they were going to have to start transmitting these annual documents to both employees. And most people, when they file their taxes, they'll receive, if they're have worked at a employer, that they'll receive this 1095 form in the mail to be filed with taxes. It's no longer a requirement for the employee to use that to file their taxes. You still will typically get one in the mail. You don't have to use it to file. If you don't have it, they're not going to hold up you filing your taxes. However, the necessity for an employer to file them has gone nowhere. You're still required to file the 1094, 1095 reporting. And with that requirement, if you don't file, you can be subject to penalties. Well, early on, we had some clients that received, we call them the 226J love letter, and it's the IRS penalty letter. And you'll talk about, as a business owner, the scariest thing you can open is a letter from the IRS, and it has a penalty description on there and a huge amount that freaks you out. So we were able to. This was for essentially where people had gone to the marketplace, gotten a subsidy incorrectly. But lucky for us, we had all the data to back up that, hey, these people were offered coverage, they declined it. Here's the filing. And so this IRS penalty essentially wasn't overnight, but it went away because they were in compliance, doing what they were supposed to be doing. And had they not had the records and documents and all that, doing the right things, they would have never been able to prove it, that, hey, you offered this person coverage. We had an electronic system that captured the enrollment, time stamped it, where it was a decline of coverage for the individual, and all that. It was a success story. And so the employers have to be prepared, especially in that regard, that the IRS and the marketplace are not inhibiting very many people. Never have I seen. I do plenty of individual work as well. They do not prohibit folks. They ask them, "Hey, do you have employer sponsored coverage?" And if they just don't answer that they do, it'll allow them to get a subsidy. Which, if you have more than 50 employees, that will put you on a list. Once you have two of those, you can potentially, if you're offering a health plan that's affordable, minimum value, all the things that you're supposed to be doing, you can get a per capita penalty for those. Good record keeping is an absolute must, and it's just doesn't have to be done overnight, but you have to have your compliance in check. And then once it's in check, review it annually to make sure that you're still, doing the right things. It's something I see, Logan, that's emerging that will be a big issue in 2025, is the notice of credible coverage, which all health plans are required to release once a year. And most groups believe that the insurers, the United Healthcare's, Blue Cross, all the insurers are sending that out to their people proactively, and they don't have to send it out. And that is totally not the case. And what it is and why it matters, the notice of credible coverage just says that, hey, this health plan has as good a coverage as Medicare Part D, because anybody that's eligible for Medicare, if they stay on your group health plan and don't join Medicare, they have to have coverage for their prescription drugs that is at least as good as Medicare, or they face individually, they will face a penalty when they finally do join Medicare. And so they don't have any way of really knowing that until you send them this letter. And if that letter is not being sent, there can certainly be pretty outrageous fines. And why it matters for 2025, this has been a rule in place for a very long time, is the amount of plans that will not be credible is going to increase, going to skyrocket in 2025. The amount of employer plans that are not any longer as good as Medicare. The reason for that is Medicare passed a rule about the drug coverage in any Medicare benefit and capped on the drug plans the maximum out of pocket to $2,000 every year. Most employer sponsored plans do not have drug coverage that good. I've talked to many people in the industry. We've internally had discussions about this. And our thought is that while most years 90 to 95% of plans have credible coverage, in 2025, that number probably drops to 30%. And so those letters for 2025 will be absolutely critical because if they don't get sent out, anybody who's remaining on your plan that's Medicare eligible is now in line to get a penalty when they finally do transition fully to Medicare. And by not sending that letter and having documented proof that you sent that letter, or in a place where some pretty nasty fines could be coming your way.
Walk me through your process if I'm an employer, a business owner. Maybe I'm a business owner or I'm a director of HR. How would you talk to me from initial conversation to administration?
Yeah, I think the first thing I would do is try to not make it like a an examination, or I'm looking at you with a microscope, or basically within a circle of trust. I do not in any way share. I'm working on your behalf. I'm not going and telling anybody that, hey, you don't have this document here. It's within a circle of trust there. And so I'll just go document by document with the most basic sort of leading up to the ones that are more commonly missing. The Section 125 plan, sometimes called the POP document, is like the basic one where if I ask for a copy of that, or do you know where that is, or whatever, the responses I get to that will really give me a good insight on what kind of interaction it will be, like how much help is going to be necessary here, because that is like the most basic document. And so if you don't have one of those today, or you've never heard of that, please ask whoever you're working with, or by all means, reach out to me and we can have that discussion. But that is like the most basic. And then from there, we'll SPD and look at your Cobra and the high level things, and then drill down a little more on the sort of periphery there as we continue. But it's not going to, I think the idea is, oh man, we don't have any of this stuff. This is going to be a lot of work. And so there's not zero work, but most of it we will either carry the majority of the burden on, or farm it out to a reliable third party administrator, a nice, like large national organization. We have many large national partners that we work with that do this at a high level and very affordably, creating these documents. And from there, get it back to center, get it back healthy and right. And then every year, typically in the summer, is when I do my compliance reviews, because most plans, not all, but a lot of plans are calendar year. And so that's where you're far enough away from renewal and enrollment. And you can typically have at least some space to think about any compliance changes that you need to be aware of. And the other thing I haven't even mentioned is like HIPAA and high tech and some of these other, that also the requirements there are pretty extreme. And that's some that are first in line to be fixed. I would say that Section 125 is always the place where we start. And then moving forward to the most material, Cobra's very far up there, and then moving our way out.
And so do you do the administration going forward for the client, or how does that work?
Yeah, so I put, depending on the size of the client, depending on their particular needs, at a minimum, I will oversee any third party. I'll be the guy to make sure that whatever compliance activities need are required are being done and done correctly. And for instance, 5,500 reporting. I'm not going to do your 5,500 report for you. We'll get a TPA. I will verify the accuracy of the finished report. and it'll be filed. It'll be oversight. And there are some things that we would totally do, providing you chip notices to send out, and we deliver those in enrollment packets as part of our annual enrollment packet. They need to be delivered at least once a year, but we have an enrollment packet that's given to every employee, and so they've received all of this information. Depending on how dispersed your employees are, we have electronic systems, so it's not just good enough to send somebody an email for distribution. The gold standard is handing them copies in person. That's not always possible, but if you do have electronic distribution, we make sure that it's capturing affirmation signatures that they have received the notices. And so that you're really checking that box here. And I know this all sounds like, oh man, it's a lot of work. And that's probably true for some. If you don't have a base starting line and there's a lot of deficiencies to begin, there might be a month of not full work, but a month where you have to really pay attention to it and let us do our part of it. And but then after that, it's much just getting your car inspected once a year. It's not anything too heavy. Rules, laws change. There'll be an update there. Companies vary in size. They may grow over the course of the year. They may sell off pieces, but getting that reviewed annually is important. And so, first little bit might be a little work, and then after that, it's not too bad.
So what kind of resources can we provide for people to learn?
Yeah, I think to the extent that there's an appetite to really understand, we have checklists that we can make available. I'm I would love if you would contact me, and I had to have the opportunity to work with you and talk you through it and help you. Take it to your advisor if you have a relationship that you just want to keep. You're welcome to use it in that regard as well. Would like to earn the opportunity to discuss it with you, but if you have a relationship that you like and is working in every other aspect, you're very welcome to use our checklist and work with that person. Because likely most benefit fit brokers are somewhat aware of the necessities of it. I think there's a distraction level, and it doesn't always float to the top of the priority list. In benefits, you're every year you're trying to really make sure from an insurance perspective that you can keep the plans affordable, negotiate the best deals for your clients, and also provide them other value adds that help achieve their goals. And sometimes compliance gets shuffled to the bottom of the deck. We look at it as a more important part of your benefits strategy. It and really that's strictly because of the activity from private equity companies and other that have to be private equity, but every day there's opportunities for transactions, and if we can work with you, you will not have that delay or headwind going into a transaction because your compliance is just not together.
Well, Brad, thanks for your time in this ongoing series. We'll look forward to the next topic. I hope this has helped people understand the a bit more the exciting, but
I hope you all can go to sleep now. It's so exciting, so riveting. You're just going to be up all night thinking about ERISA. Yeah.
yeah, but also valuable and often overlooked world of compliance. Thanks so much for your time, Brad. We appreciate it.
Yeah. Thanks a lot.